Hey there, investor. Have you ever heard of the MSCI World Index? Or maybe the MSCI Emerging Markets? You probably have. They're the go-to for thousands of funds and ETFs all over the world. But have you ever stopped to think about who's behind these indexes? Who's the company that sets the rules for trillions of dollars in assets? Today we're going to take a deep dive into MSCI Inc., a real quiet giant in the financial market. MSCI is way more than just an index creator. It's a powerhouse of data, software, and smart insights that's right at the heart of the global investment world. In this video, we'll break down MSCI's business model, understand its competitive advantages, what drives its growth, and the risks it faces. By the end, you'll have a full picture of how this company works and why it's so powerful. So, if you want to understand the gears behind your investments, stick with me. Let's start by uncovering MSCI's crown jewel, its amazing index business. The crown jewel, the index empire. To understand MSCI, we first need to understand its main business, which makes up more than half of its income and over 70% of its operating profit: indexes. MSCI isn't just another company in the market, it's the absolute leader in indexes outside the United States. About $17 trillion in assets use MSCI indexes as a benchmark. That's more than the GDP of many countries combined. But the golden question is, how do they make money from this? Basically, in three ways. First, subscriptions. Active fund managers, the ones who try to beat the market, pay a subscription to use MSCI's index data. Why? Because their clients, the investors, demand that the fund's performance be compared to a reliable benchmark. It's a small cost for the manager, but it's essential. And once an index becomes the standard, like the MSCI Emerging Markets, no one wants to switch. This creates recurring income with strong pricing power. Second, and most important, asset-based fees. This is the golden goose. You know those cheap passive ETFs that have become so popular? Many of them copy an MSCI index. For every dollar you invest in a BlackRock ETF that tracks the MSCI World, for example, MSCI gets a tiny piece, a license fee. It might seem small, about 2.4 basis points. But when you multiply that by trillions of dollars, the income is huge. This income source directly benefits from market growth and the flow of money into passive investments. It's one of the best ways to be exposed to this long-term trend. Of course, there's a concentration of clients here. BlackRock, with its iShares ETFs, accounts for almost half of these fees. MSCI has a 10-year contract with them, which brings security, but also shows how important this relationship is. Third, transaction royalties. MSCI also licenses its indexes for creating derivative products, like futures and options. Every time one of these contracts is traded on partner exchanges, MSCI earns a small royalty. It's a smaller business, but it's growing fast. To sum it up, the index business is a cash-generating machine. It's essential, has recurring income, pricing power, and rides the wave of passive investing. It's the foundation of MSCI's empire. Beyond the indexes, the other arms of MSCI. But MSCI doesn't just live off indexes. The company used the strength of its main business to grow into other important areas. Let's learn about the other three parts of the company. 1. Analytics. This part makes up about a quarter of their money. It offers smart computer programs for managing risks and looking at investments. Imagine a big retirement fund. It needs tools to understand the risks of its investments in different economic situations. MSCI sells that solution. It's a good business with customers who tend to stick around. Once these tools are part of a client's daily work, it's very expensive and hard to switch to something else. However, there's more competition here, with companies like FactSet, Bloomberg, and even BlackRock's own Aladdin system. 2. Sustainability and climate, ESG. A few years ago, investing based on environmental, social, and governance factors, known as ESG, was seen as the next big thing. MSCI became a leader, creating ratings and data for over 14,000 companies. The problem? This part of the business has slowed down recently. A mix of ESG strategies not doing so well and a political backlash, especially in the United States, cooled down the market. It's still important, but it's not the super fast growth engine it was once thought to be. 3 private assets, and here's MSCI's new big bet. Investing in things that aren't traded on the stock market, like private equity and commercial real estate, is growing a lot. The biggest challenge in this market is that there isn't much public or standard information. MSCI saw this chance and bought some key companies, like Real Capital Analytics in 2021, which focuses on real estate data, and Burgiss in 2023, which provides data on how private investments are doing directly from investors. The idea here is simple. If MSCI can become the go-to source for data in the private market, just like it is for the public market, the potential for growth is huge. These parts of the business show that MSCI isn't standing still. It's always looking for new ways to grow, using its brand and its knowledge of data. The economic moat. Why is MSCI so dominant? Now that we know about the businesses, let's get to the main point for any long-term investor. What's MSCI's competitive edge? What stops a competitor from just creating their own indexes and stealing their market? The answer lies in a concept we call an economic moat. MSCI's moat is built on 2 main pillars: intangible assets and high switching costs. Intangible assets. The main asset here is the brand and reputation. MSCI indexes have been the industry standard for decades. An asset manager might even prefer a competing index, but if their clients and consultants use MSCI as a benchmark, they're practically forced to use it too, so they don't risk losing clients. The MSCI brand is a symbol of trust and standardization in the global market. Switching costs. This is especially strong in the analytics segment, but it also applies to indexes. Changing a benchmark or risk software isn't like switching cell phone brands. It involves reconfiguring systems, training teams, and changing the entire way performance reports are made. It's an expensive, time-consuming, and risky process. Because of this, MSCI's customer retention rate is super high, usually above 94%. Once you're in the MSCI system, it's really hard to leave. This moat allows MSCI to do something few companies can. Have consistent pricing power. The company can increase its subscription prices by 3% to 4% each year, regularly, simply because its services are essential for its clients. It's this combination of brand, standardization, and switching costs that creates a really strong barrier to entry and supports the company's high profitability over time. Bulls versus bears. The debate on MSCI's future. No company is perfect. To get a balanced view, we need to look at both sides of the coin. Let's check out the main arguments from the optimists, the bulls, and the pessimists, the bears. On the bulls' side, the arguments are strong. 1. Beneficiary of passivization. The shift from active to passive investments, ETFs, is a trend that's not going to stop. MSCI is right in the middle of this change, and its growth in asset-based fees should keep going up. 2. Pricing power. As we've seen, the moat ensures that MSCI can keep raising its prices faster than inflation, which is a big driver for revenue and margin growth. 3. New frontier in private assets. If the bet on private assets with RCA and Burgiss works out, this could unlock a new wave of growth for the company, just like the success it had in public markets. Now, on the bears' side, the risks are also real and need to be thought about. 1. Market cycles. With a bigger part of its income coming from asset-based fees, MSCI is more open to long downturns in the stock market. If markets fall, the value of assets under management goes down, and MSCI's income goes down too. The business has become more tied to market ups and downs. 2. Concentration risk. The reliance on BlackRock is the main risk. About 10% of the company's total income comes from just one client. Even though the 10-year contract gives some safety, BlackRock has huge bargaining power and can always push for lower fees in the future. Plus, BlackRock directly competes with MSCI in the analytics segment with its Aladdin system. 3. Pressure on active managers. MSCI's subscription clients are mostly active managers. This sector is under pressure, with money leaving and fees getting squeezed. Trouble for them could mean fewer sales for MSCI. Understanding these two sides is super important to fully check out the investment idea for MSCI. Management and financial health. A big company needs good management and strong finances. How does MSCI do in these areas? Financially, the company is very strong. It has about $4.5 billion in debt, which means its debt is about 2.3 times its EBITDA. For a company with such steady and predictable income, this level of debt is considered healthy and easy to manage. The debt payments are spread out nicely in the future, between 2029 and 2033, so there are no worries for the short term. One of the big highlights is how careful they are with costs. Since 2015, after some pressure from an active investor, management became super efficient. This made their EBITDA margin jump from 41% to the current 60%. This means for every dollar they earn, a lot more of it turns into operating profit. When we talk about how they use their money, MSCI is a great example. The CEO, Henry Fernandez, has been in charge since 1998 and led the company through its IPO in 2007. He has a proven track record of smart decisions, like buying Barra and Risk Metrics, which created their analytics segment, and more recently, focusing on ESG and private assets. At the same time, he knew when to sell businesses that weren't doing so well. The company is also very friendly to its shareholders. It gives money back through dividends and buying back its own shares. And the most interesting part is that they are smart about when they buy back shares. They buy more when the price is low, like they did during the dip in March 2020, and they slow down when the price is high. This shows that management is focused on creating real value for long-term shareholders. Conclusion. We've reached the end of our look at MSCI. So, what can we say we've learned? MSCI is a really high-quality company. It has a main business, indexes, that's super strong, with a big advantage based on its brand and how hard it is for customers to switch away. This gives them money coming in regularly and amazing power to set prices. They're set up perfectly to benefit from the long-term trend of passive investing, and they're making smart moves into new areas that are growing, like private assets. Their leaders are experienced, careful with money, and have a great history of using money wisely. The result is a company with really high profits and strong finances. Of course, there are risks. Depending on BlackRock and being affected by market ups and downs are the main things any investor should watch closely. MSCI is a perfect example of a company that works behind the scenes, but is super important for how the global financial market runs. It's truly a key part of the system. I hope this analysis helped you understand this fascinating company better. Remember, this video is for learning and isn't advice to buy or sell anything. Always do your own research. What do you think of MSCI? Did you know how powerful their business model is? Leave your thoughts in the comments below. Let's talk about it. And if you liked this kind of analysis, don't forget to hit that like button, subscribe to the channel, and turn on notifications so you don't miss our next videos. See you next time.